I'm Charlotte McLeod with the Investing News Network, and here today with me is Nick Barisheff, President and CEO of BMG Group and author of the book $10,000 Gold. Thank you so much for being here online with me today.
Oh, my pleasure, Charlotte.
Of course. Now, we're here today to talk about what's going on in silver. It's a very interesting time in the silver market. To start off, I hoped you could give a quick recap of what we've seen over the last few weeks. I think our audience here is probably at this point pretty familiar with how the whole silver squeeze story got started, but maybe not how it's proceeded over these last couple of weeks.
Right. Well, I think the thing that people should understand, there's two components. There's the difficulty of getting silver for the SLV and also the COMEX. So March is a month where you can ask for delivery, and we'll see actually after today. There's an expectation that a lot of people are going to stand for delivery. Typically on the COMEX futures, 90% settle in cash and don't ask for delivery. And the problem the COMEX has is they have some estimates 100 contracts for every ounce of silver. So, if everybody stands for delivery, then we have a big problem at the COMEX. So that's one area. The second thing in the SLV, and there it's important to compare the silver ETFs to the gold ETFs. So in all the ETFs, the trustees or the custodians of it, they don't go out and buy silver as investors buy shares. They have authorized participants, which are typically the big banks and brokerage houses. They contribute a basket to the ETFs. In the case of gold, it's 400 ounce bars. In the case of silver, it's 1,000 ounce bars. So that's where the difference lies. The thing is that in gold, central banks purportedly hold 30,000 tons of gold in the various central banks. So the authorized participants typically can borrow gold from a central bank and they contribute it to the ETF. But central banks don't hold silver, and there's a limited amount of physical silver in London. So if more and more people buy shares, they could effectively run out of silver. So in anticipation with that last week, the SLV changed the prospectus that basically said there's no assurance that we'll get to silver, and the price of the shares could be volatile. We may even shut it down, et cetera, et cetera. So this was an abrupt change to the prospectus. I think it was last week or maybe the week before, in anticipation of this. So we'll see. I mean, and this got started obviously because of the shorts and the whole Reddit crowd. Silver is a much bigger, tougher market to do the same thing as they accomplished with GameStop, but it's still at some point possible. So if that happens, you can have a combination of problems, one at the COMEX and two at the ETFs.
Right. And just to be clear, so you've been doing a lot of research on SLV as you've been speaking about. Why did you decide to be looking at that ETF in particular? Because there are other silver ETFs out there that investors do have some interest in. So maybe if you could just clarify that process.
It's the biggest and most popular. So when they go through the data in terms of how many shares are being sold, it's that much more difficult for the SLV to source the physical silver. So if there's going to be a problem, it's going to show up in the SLV, more so than anywhere else, just due to the popularity.
Okay, that makes a lot of sense. So, as you've been doing all this research, you've been laying it out for us here, what would be the main thing that you would want investors to take away from it? Because this is a very complex situation, and I think a lot of people are left not knowing quite what to do.
Well, the issue is that the ETFs are a tracking vehicle, not an ownership vehicle. And particularly in the GLD ETF, says that on the front page. So if you've sat through as many prospectus drafting sessions as I have, you would say, why did they use the word tracking? I thought you're buying the silver. Well, they're not buying the silver. All it is a mechanism for tracking the price. And in very simple terms, like if you and I had a bet on tomorrow's silver price, we don't need any silver. You just need to have the money to pay me if I win and vice versa. So that's essentially what the ETFs do. They're not about ownership. And that kind of thing works in financial assets and so on and so forth. But when it comes to precious metals, it's critical that you actually own the stuff. And as long as you differentiate that, like some people, they have the time and the skill, that they're good traders. So it's an acceptable trading vehicle. But it's not about owning gold or silver at all. And that's the big difference. What I typically recommend to investors is they acquire physical gold and silver, and then they can hedge it using puts or calls on an ETF. So either enhance the performance or hedge the downside. That way you've only got a very small amount of money in the puts and calls, and your physical position is secure.
Yeah, so you have to be a little bit strategic if you're an investor who's trying to deal with this. Okay, one question that I have is, we've been talking here at INN to a lot of experts who are trying to help us understand this situation. I do know that there are people out there who don't believe there's really anything wrong going on in the silver market or with the ETFs. What would you say to people who maybe don't see that? They don't think that there's a problem with the way things are going right now.
Well, I think that's kind of negated because there's a ratio of gold to silver. So the ratio of physical gold to silver in the ground is about 15-1. So that's the usual ratio. And under the US Coinage Act that got abandoned some years ago, the ratio of gold to silver was also 15-1. So now it's about 60-1. And I think it got as high as 100-1. So that shows you that silver is grossly underpriced relative to gold. That's number one, because the historic mean is about 40-1, and a number of times it's got as low as 30-1. So silver has a lot of catching up to do relative to gold. But then you'll say, well, is gold fairly valued? And my answer to that is no, because gold and the debt, the U.S. debt, was perfectly correlated till about 2011, and then they diverged. U.S. debt kept going up and now has accelerated, and the gold price fell off. So right now, the gold price, to get it back to equilibrium, the long-term equilibrium, would be about 2,200 an ounce. So you've got a situation where gold's undervalued, silver's undervalued. And when you compare that to all other investments, most other investments, particularly stocks and everything, are grossly overvalued. We have the most overvalued equity markets even since 1929. But yet you have gold and silver undervalued.
So right now, did you say a fair price for gold would be 2,200? What's the fair price for silver at the moment, in your view?
Well, if gold's 2,200, then silver at 30 times, I guess it's what, $60, something like that.
Right. And of course, you're well known for your $10,000 gold call. You have the book. What's the long-term price potential for silver?
Well, again, if you get to $10,000 gold and you get down to a ratio there 30 to 1, that'll be your silver price. So that's what I think the long-term potential is. Now, so when these markets, are out of equilibrium, they can overshoot equilibrium. And the issue is, it's unlike gold, silver has two completely different utilities. Gold is primarily a monetary asset. It's got limited industrial and technology uses, but relatively limited. Silver is both a monetary asset and very necessary in technology, like everything electronic has silver, solar panels have silver, electric cars have silver. So it's got a lot of utility. The other difference is that when it comes to mining, even though silver is more abundant than gold, the 80% of the silver mined is byproduct silver, if not pure silver, not mines, where many of the gold mines are pure silver mines. So the implication of that is that if the silver price was to go up, let's even say tenfold, then you can't adjust mine supply. You're not going to dig up, tons and tons of copper to get a few more ounces of silver, because the price is 10 times on silver. So you don't have an adjustment in supply. And even in demand, even though silver is used in a lot of electronics, but it's a minuscule amount. Like, say, in your cell phone, I doubt that there's 10 cents worth of silver. So if the silver went up tenfold and it was $1, nobody would care. So you've got an interesting situation that makes silver both supply and demand inelastic. Most of the time, if something goes up in price, the demand goes down and the supply goes up to kind of bring it back to equilibrium. But that's very difficult to accomplish in silver. So you can have a situation where the price goes up way out of proportion because of these conditions.
All right. You've given us a lot to think about this silver situation. And I think probably what our audience is going to be wondering is, where do we go next? What's next for silver in the immediate term? Are we really going to see a silver squeeze like some people are predicting? What are your thoughts?
Well, it's at this point in time today is a coin toss, because the major bullion banks and so on that are that are short silver are going to do everything in their power to keep the price down before the expiry of the March delivery contracts on the COMEX. So if they're successful, you can have a short-term decline. But once option expiry is over at the end of the month, then you could see a spike. Now, they could fail in keeping it down, but so far, all the other times, they haven't. You know, when you look into going into option expiry, the price typically goes down.
All right. Any final thoughts you would leave investors with during this interesting time for silver?
Well, it depends on the kind of investor. For most investors, my recommendation is simply buy more silver at every opportunity. Have it in your possession and keep waiting for it to rise. People keep wondering, when is it going to spike? When is it going to go crazy? Well, it doesn't have to go crazy. Before I started the company, which was 1998, I bought a lot of silver at $2.50. So I don't care what the price is. I'm doing okay.
I think that's a great point to end on. It doesn't have to go crazy.
That's
All
right.
right. Well, thank you. Thank you so much for joining us today to talk about what's going on in silver. It was great to have you once again.
Okay. Thank you, Charlotte. Take care.
Yes, and I'm Charlotte McLeod with the Investing News Network, and this is Nick Barisheff of BMG Group, and author of the book $10,000 Gold.